Welcome to Train Future, where ambition meets expertise. At Train Future, we believe in the transformative power of mentorship and training. In this podcast series, I interview leaders and experts from various fields. Today, I'm pleased to introduce Vikram Sengupta. He holds a master's degree in economics and an MBA in finance from IIM Calcutta. Vikram has an extensive experience in capital markets and multinational corporations across the US, the UK, and India. He began his career in investment banking at firms like Nomura and later held senior leadership roles at Anand Rathi and Legacy Investment Manager. He's now the CEO of Stratmore Wealth and the co-founder of OAWA. This interview today will focus on Vikram's personal journey and his views on the Indian and global capital market trends. We'll also talk about the structural themes that he believes will shape asset allocation over the next decade, especially with the growing impact of AI. Vikram, thank you so much for joining today. Could you walk us through your career journey, from your time in institutional equities at Nomura to leading at Legacy Investment Managers to the CEO of Stratmore Wealth and co-founder of OAWA?
Well, it is not as glorifying as it's sounding now. Actually, my Nomura days was an outcome of bankruptcy filed by Lehman Brothers, which I was part of, and I guess you and a lot many of students and these days young aspiring investment bankers have gone through that history of how Lehman filed for bankruptcy, what happened. So as part of Lehman Brothers and part of the Asia and Europe franchise, which got bought out by Nomura, and the US franchise of Lehman Brothers was bought out by Barclays. So yeah, I think the main thing about being part of this entire investment banking setup is that it was not a very planned one. It's not that I was dreaming to be, or rather, I had planned this to be happening in my life. It somehow it happened, and but the bigger challenge is once you get inside, how you cope with that entire pressure and the kind of people that you deal with. So I was very lucky to have worked with some wonderful colleagues within the firm, and of course, I had great people to work with outside also, and that gave me a lot of learning as far as building my fundamental, having a better understanding of capital market from the basic till the advanced side. Subsequently, what happened was in 2014, I was back in India and I was very keen to start an entity of my own. And I thought, given my experience, my educational experience also is in the field of economics and MBA finance. So, and given the fact that I'd spent some time in the capital market space, so I thought wealth management would be something that would sync well. I had worked briefly with the one local firm here in India, which is quite big now. And subsequently, I started my own venture. This was sometime early 2016. Post which I started meeting a lot of investors. I wanted to first understand what is happening in India as far as high net worth individuals are concerned, what kind of investments they are undertaking, what kind of returns they are making, and then there was a brief period of time when we had you can say a business engagement with a firm named Legacy Investment Managers, and I was building their south as well as the the eastern part of the business. And in 2020, just before COVID started, I co-founded, or rather, renamed my earlier firm and started off as Stratmore Wealth. One of my ex-colleagues joined me. He looks after something called estate planning, which is basically protection of wealth through various means and mechanism. And I'm part of managing investment. And so, yeah, it's been a reasonably long, but a very fulfilling journey, I would say. And I've always been lucky that I've worked with brilliant people, both as my mentors, as my clients, and it's a great learning opportunity.
That's a fascinating journey. I mean, you've gained so much experience in public and private markets. But let's go back to where it all started. You started working as an investment banker in Lehman Brothers and then shifted to institutional equities at Nomura. What first drew you to investment banking and capital markets, specifically equities? And what lessons still guide you today from that journey?
I'll more concentrate on the key things that helped me there, or rather, what I value the most from that experience. I think you're exposed to a group of people who are extremely knowledgeable, talented, however you want to put it. They have seen different cycles, different markets, different time frames. First thing first, which helped me, and that I still hold as my as a key benefit, it made your fundamentals very strong. Your fundamental understanding of basics, theory, which you typically learn in college, and many a times you don't get to revisit it for a long time. A place like that made sure that you are well ingrained as far as getting a fundamental right. Because first, when I entered, I was very overwhelmed because I saw people, it seemed like this is a completely different level altogether, and I may not be able to fit into this. With time, you start understanding how things happen, how in real life, apart from theory that you learn in books, how in real life things are done. And yes, time and again, you have to go back to your fundamentals. So it really helped me to build upon my fundamental knowledge. And that is the key ingredient which helps me till date.
Wow, that's amazing. And to add to that, you've worked across US, UK, and India. How do those experiences influence the asset allocation you do for high net worth clients investing globally?
Understand. Again, I'll go back to that same fundamental thought process which I was talking about, that rules of asset allocation are more or less same across the world. And as long as your understanding of those asset classes are strong enough, you will be able to cut across the noise and complexity and figure out what really matters. And the more you get exposed to different geographies, it helps you to understand people, their psychology, what are the risks they perceive. Some are perceived risks, some are actual risk. How do you deal with that? A lot of, I mean, I would say bulk of investment is actually psychological, because end of the day, asset classes behave as they would, irrespective of whoever is holding it. But this is the person who's holding it and his psychology, which plays a very important role in terms of taking the maximum or extracting the maximum benefit from it. So, so these different geographies help you understand to how different segment of people think and what they perceive as good, what they perceive as risky. And accordingly, you can understand that what are the value additions that you have to do in this process in each of these geographies to make certain things happen. So, yeah, working in different geographies certainly help, but more from the standpoint of understanding people and rather than understanding, asset classes, which more or less follow the same principle in most part of the world.
That's a great take, especially now with tax friction, currency volatility, and regulatory changes. It's playing a bigger role in returns than before. But zooming into today's macros, how do you see portfolio capital flowing between US and emerging market equities, especially India, in the context of this US tariff situation?
Well, while it is still a developing scenario as we speak, and every day you are witnessing some new parameters coming into the play, and it is still yet to play out its full part. And as we speak, there are still negotiations happening between countries in terms of trade, in terms of tariff, in terms of, terms of these trades which are being worked out. But I will go back to the same thought process of the fundamental. See, end of the day, capital follows growth. Wherever it will see growth, that is where the slope will tilt. I mean, and that is where finally capital will move in. I personally believe that India right now, and it is coming out in various data points that seem to be one of the fastest growing countries in the world. And I also believe that India's growth story is, while it has been there for few decades now, but the advantage that we will enjoy now in the coming few decades will be significantly higher because there are some demographic dividends that India is enjoying in terms of population, in terms of working population mix, in terms of the all both genders coming into the play as far as adding to productivity is concerned, and that this entire thought process of value creation in various businesses It is very evident in today's numbers that are coming out, as far as whether you call it GDP growth, whether you call it economic growth, whether you look at our domestic industries. Secondly, you have to remember that India typically has not been a great or rather big in export. That is a big change which probably is happening as we speak, as the terms of trade is beginning to change. So we see that India will play a far bigger role in being an export hub for a lot of products. I mean, today we are talking about Apple making India is one of the key export hub, and I'm sure that this is just the beginning. Many more companies, many more products are looking at India in terms of creating that production center such that it caters to the world market. Remember, that can only happen when you have a reasonably large skilled manpower, which can supplement to that those industries coming in. And India, thankfully, probably is, I would say, while I don't have exact data points to highlight, but I would tend to think that as far as skilled workforce is concerned, India probably today would be the best, one of the best in the country, in the world.
Yeah.
So, like I said, that we are probably being looked upon the next alternative to China, and with a far more healthier mix as far as workforce is concerned.
Okay. There's a lot of discussion right now among global CIOs about how to navigate the disruption caused by geopolitics. What's encouraging is that despite all the short-term uncertainty, markets like India are increasingly seen as long-term winners as global trade and investment patterns start to shift. But do you see any long-term investment themes emerging from this tariff situation with the US? For example, could this accelerate trends like supply chain diversification, automation, and manufacturing efficiencies as companies try to offset higher import costs?
What's happening is that tariff is in a way uh, trying to protect your domestic industry. First of all, you need a thriving domestic industry to cater to the existing goods and services at a certain cost for tariffs to work. Now, if you're putting in tariff where the other alternative is that you are relying on a domestic industry which is not efficient enough, in a way, you're kind of putting a burden to your own country. Now, in India's case, I believe that today the, coun- the country is matured enough to face competition from outside. Because today, if I look at automobile segment, whether I look at any segment, chemicals, automobiles, electronics, etc., etc. I think the kind of efficiency that Indian companies have brought in, even with the tariffs getting removed in India and making it a level playing field, which I think in a way probably US is also asking for, I still feel that Indian companies would be quite competitive in most of the areas. So it actually tariff in a way literally forces a country to improve efficiency and ensures the fact that your domestic ability of be it production, be it supply chain, it becomes strong enough such that you can cater to the domestic market. And in India's case, I think it is a lot which has already there in place, and of course there is more to come.
Yes, I mean, we're seeing a long-term strategic shift in global supply chain and investment planning, which brings us to how portfolios are actually adapting to this, especially in this fast evolving market like India. So that brings me to my next question. How are managers using AI to stay ahead? How is AI being used specifically to monitor real time risk, asset allocation across equity, fixed income, and other hybrid funds in India?
A couple of things before I move into the technological part of it. See, again, as I said, the capital will only follow where there is growth and there is a certainty and longevity of policy. Now, if I'm running a business and I want to make an investment to start a production capacity in any country,
Yeah.
I have to commit capital to that for whatever. given size or scale that I want to achieve. Now, if I see that the policies are uncertain in a country where, my capital, which which I spend to bring up production facilities, and that might be at risk because of constant change in policy, constant change in government, constant change in, there is an uncertainty all around, then definitely that is not the place where I would risk my capital. So in India's case, what is coming out, which is why you are seeing so much of global money coming into India, and I tend to believe it's just the beginning of that flow, because there is policy certainty now pretty much in place, whether it is from the government side, whether it is from the central bank side, whether it is from, the political standpoint. So hence it gives, and on top of it, you are getting into a country which offers you very low cost, high skilled resource. So it is like a Goldilocks situation for any company to come and start a business in India. Earlier, there used to be a thought process that, there are state-wise challenges. But today, as we are seeing, all state governments are, aligned to the idea of growth, because they clearly realize that if I can today grow my state, my exchequer become more strong. I am in a better position to put out more better infrastructure, and there is receipt from the tax, they receive from every other side. As a whole, my state goes up in terms of prosperity as such. So, that is the reason I feel that in the current regime, India offers that certainty for capital to be rest assured being utilized the most efficiently. Now, coming to the point that is there a mechanism by which technology, and I think today's world, AI or artificial intelligence is used very loosely, and I feel that there are enough ways and means through which technology is touching our daily lives. And right now, as I see that for any risk management, process or any risk management system, would be using certain algorithms, certain mechanism, which obviously will have influence of artificial intelligence coming in. And I think, again, I said that these are evolving subject matter, but certainly as we move ahead, it seemed to be the cornerstone of everything that we do. So today, if I look at any podcast, or today, if I reach out to any online content, I think there is a background AI which is at play. So if that were to be the case just for me as an individual, imagine the kind of sophistication that will be built in different risk management tools. Now, coming into asset allocation, I still feel that it will not be a mechanized decision. It will still need human intervention to take because it needs a certain kind of predictive ability to figure out what kind of asset allocation one would go on. Just to let you know, we were of the opinion that gold more or less in India, I'm saying gold more or less mirrors the dollar. Now we are seeing that relationship getting broken. We are seeing central banks around the world literally hoarding gold, and we are seeing gold on its own seeing a significant hike in prices all over the world. As geopolitical risks also increase around the world, gold becomes the suitable form of reserve for most countries. Now, there was a time when we used to think, why are Indian households saving on so much of gold? Today, that is coming and helping a country like India massively, because a lot of our savings are embedded in gold holdings. So now the question is, was that asset allocation could have been understood then? No. So you need to be very, very dynamic today to figure out how risks, come evolve, what are the risk mitigation techniques, and accordingly decide your asset allocation. In my opinion, while you can say that I'm completely biased, in a country like India, I would be far more aligned to growth asset class like equities, because I think growth is something which India will far outstrip the rest of the world. And there are other asset classes today in India which are suitable results of value, whether it is in terms of gold, in terms of government debt, and other means. So I'm not still sure whether I would use AI to determine my asset allocation, but I would rather use AI to show me red flags if there are any problems in the asset allocation.
What's exciting is that these tools aren't just like for institutional portfolios anymore. Even HNIs and retail platforms are starting to offer AI enhanced dashboards, and it's really changing the Indian markets. I really believe that this is a game changer. But my next question is a bit different and more general. I'm curious, over the years, has there been one investment that shifted your thinking or framework in a lasting way?
See, in India, and again, I'll borrow my thoughts because most of my uh, experience has been India specific. In India, we have been talking about time value of money or the effects of compounding. Now, while we keep saying it and treat it like a theoretical exercise, there has been an instance, an accidental investment which have been done by me many years in a simple mutual fund, which over a period of time has generated a multiple of 70 to 80 times. Now, which means that today, if one had invested 20 years back, say around 3 or 4 lakh rupees, that value today will be, say, 70 times of that. Now, I don't know too many countries where that kind of compounding would have happened, barring few stocks, of course. But I'm here saying a diversified basic mutual fund scheme in India 20 years back had some invested and not disturbed it over a period of say 20 long years, which in today's world is a fairly long period of time. That would have been a game changer kind of an investment for anybody by any stretch of imagination. So I think the principle of compounding and time value of money is something that I have learned through that experience and something that I'm always building upon as far as my value proposition that I offer to investors. Because we tend to underestimate and not appreciate it to the extent that it should be, especially in a country like ours.
Looking forward, now let's say 5 years ahead, what single macro trend do you believe investors still underestimate today? And how are you positioning portfolios to protect against it?
Mm, Again, I will talk of in India, and maybe this will have an implication world over. As I see the biggest threat coming up for our next generation, more so towards the end of our generation as well, is cost of healthcare. Health related costs, in my opinion, will be the single biggest drag for every individual today living in this world. And any businesses which are aligned to addressing that would probably see a significant or a massive growth potential. That's one. That's on the positive side as far as investment theme, I would say. One can look at it pharmaceuticals, one can look at research on capabilities, one can look at hospitals, one can look at a diagnostic center, all allied fields of healthcare. But the other, or rather the problem area of this is that our health costs will shoot through the roof. And the unfortunate part is that today, thanks to the way the world is shaping up, it is not the way we used to be maybe in our uh, time when we were growing up, because we were definitely physically more active. Today, world has become far more comfortable with certain section of people. I'm not saying it for all, where movement, human, interaction, all that is getting curtailed. We are in a way of trying to bring in ease. We are in a way making our mind and body that much more vulnerable to lot of disease, lot of health related issues, and which I think will ensure that our health maintenance costs will shoot through the roof. So as a result of which, if you're trying to think that my only cost will be involved as far as my staying, living, eating cost is concerned, I think we are grossly underestimating what kind of impact health costs will come up. And as I see in India, and I am expecting the same to hold elsewhere also, the cost will spiral through the roof. And that will be a single biggest drag, whether it is on government expenses, whether it will be on individual expenses. So choosing a growth asset class and using your asset allocation accordingly will become very important for you to counter this kind of inflationary pressure on healthcare costs. And earlier, we used to think that healthcare costs will only come to us when we are in our 50s and 60s. The very saddening and unfortunate part is, I think our next generation will probably face certain health issues at much earlier age. As a result of which, we need to be well attuned and be conscious of it. While it presents as a business opportunity for certain segment, it also presents as a risk to the largest population. And that is something that I think, is one of the key themes which will come out in the coming, not just for 5 years, even more.
Initially, Pharma were spared in the US tariff situation, prompting Indian drug makers' shares to increase. But shortly after warned that the pharma tariffs are coming soon, the very next day, Indian pharma stocks plunged like 4 to 6% across the board. So that brings me to my question. Given that the US imports nearly 9 billion US dollars of Indian pharmaceutical products annually, which were exempt from tariffs before, how do you gauge the risk to reward for the pharma sector now?
The the potential of pharmaceutical is not just on the fact that of what we are producing or what we are exporting to the US or to any other country. The potential of the pharma sector is what we are about to discover, and how many stages of discovery Indian companies are currently involved in. And I see that number, going through the roof. And while there will be, as we call it, uh, generic drugs which will see price erosion at certain point of time, which of course is good for the society at large, but there will be specialized, discoveries from a basic clinical trial to finally the approval stage and finally the availability stage. I think that India probably will be one of the key leading players in the world, and a lot of it will come out. Because one thing you remember, that whatever problems we had in terms of quality, in terms of standards which the FDA maintains, today most of the pharmaceutical companies in India are having state-of-art facility, and lots of uh, funding and lot of capital is being spent on research. Some of the large companies have their larger research centers. Some of the research centers are separately getting listed on the stock exchange. So what point I'm trying to make here is that whatever we are seeing, being the market that we are using, like whether it's Europe or whether it's US, it probably that market will expand exponentially over the coming few decades.
This has been incredibly insightful, Vikram. Thank you so much. Your insights were amazing, both big picture and tactical shifts. Thank you so much. Have a great day.
Thank you, Ishan. Thank you. It was lovely talking to you, and look forward to connecting back whenever possible next. Thank you.